Everyone says real estate in Toronto is the best investment, but is that really true? Today, I'm going to be walking you through a real life client case study. She bought a condo downtown Toronto about 11 years ago, and she just sold it this year, 2025. And I'm going to break down for you exactly how much she made, the taxes she paid, and whether it was worth it in the end. We're going to be going through some numbers, so let's dive in. My client bought the condo about 11 years ago, 2014. It was a one bedroom plus den, two washroom condo. This is a decent sized condo. Older building, but in a very desirable neighborhood downtown. She lived in it for about 6 years, so that was her primary residence, and then she moved out and bought a house with her partner. She took out some equity, about $240,000, to help with the down payment on the house. So as a result, when she sold the condo, the mortgage was larger than the original purchase price of about $459,000. She sold for $705,000 and she got what she hoped for and a little bit more and a less than 30-day closing. Now, all things considered, with what's happening right now in the condo market in Toronto, August of 2025, she was really happy with the terms of the offer. She also added about $8,000 in minor improvements. This gets added to the adjusted cost base, so I'm going to show you what that looks like. And roughly 50% of the time that she lived in it was her primary residence. So about half of what she makes in capital gains will be taxed. Now going into the cash flow of this rental. She started renting it out in 2020. And so the first 2 years of renting, 2020, 2021, she was net positive. And then over the last several years, from 2022 up to the time she sold in 2025, she was cash flow negative. So overall, if we add up all of the positive cash flow, negative cash flow from renting, she was negative $37,000. Okay, so negative cash flow in total from the entire period of renting from 2020 to 2025 up until selling point. For some context, this year in 2025, she was subsidizing her rental property of about $600 per month. That was her carry cost. Her tenants were just not covering the entire cost of owning because the rental rates just had to be competitive with the market rates. She was net positive in 2020, 2021. Interest rates were low and she was on a variable rate. So rates were low, they went up, they shot up really quickly, and then they went back down. So again, negative cash flow mainly due to interest costs, which is very typical of a rental property condo in Toronto. But also, maintenance costs were on the rise. Again, this is an older building. So with older builds, the maintenance costs are generally higher. These maintenance costs can actually put a ceiling on the value of a property, right? Because when people are buying, they have to factor in everything, the total cost of owning a condo. And maintenance costs is one of those things that people have to be aware of because they generally do not go down. They never go down, they only go up. And as the building gets older, there's going to be more substantial repairs, and that cost gets passed down to the owners. So now let's get into the taxes, the capital gains taxes paid on this rental property. Okay, so only a portion of it is taxable because there were 6 years out of the 11 years where it was her principal residence. And so with the CRA calculation, it's 6 years principal residence exempt. So the formula ends up being 6 plus 1. The CRA allows you to add 1 year. That's the formula that they allow. They give you basically a year of like grace period. And because it's your first property in doing this, CRA allows for the +1 calculation. So 7 out of the 11, 64% of capital gain is exempt from taxes. So 36% of her capital gains are taxable. Now let's get into the spreadsheet, the calculation, breaking down the cash flow numbers, net proceeds after taxes, and paying everything down. What does she take home? So let's look at the taxation on this property. She bought the property for $458,500. Now the renos that she did, some upgrades, a paint job and whatever that would get her condo ready for sale, that gets added to the purchase price. And this is how we calculate the adjusted cost base. So when we take her sale price, she got $705,000 for the condo, and we subtract the adjusted cost base. This is how we're going to calculate her capital gain. So it ends up being $238,500. Now, this is just a rough estimate. There could be other renovations she has done that could be added to this. So we'll leave this up to accountant, but for the sake of this calculation, I'm just going to put $8,000 minus the agent fees for selling the property, closing costs, lawyer fees. Her taxable before the exemption is $205,300. Now remember, 6 years that she's lived in there is exempt from capital gains taxes, right? So when we apply the 6 plus 1, just 7 divided by 11, this capital gain is exempt from taxes. So her taxable proceeds ends up being $74,655. Now with capital gains, again, 50% of it is taxable. So we take this divided by 2, and $37,327 ends up being her taxable proceeds. And she's in the 43.4% marginal tax rate. This ends up being that she's going to be on the hook for about $16,000 of taxes from the sale of this investment property. So in calculating what she gets to take home from this, she gets $705,000 upon closing. She's got a $530,000 mortgage. This mortgage balance, as you can see, is larger than the purchase price. Why is that? Because she took out $240,000 of equity when she moved out to buy her current principal residence. She's got to pay down the current mortgage balance minus her total selling costs, agent fees, lawyer fees, all that stuff, and then her capital gains tax. She takes home about $125,000, $126,000 from the sale of this condo. Now, is this good? Is this bad? What is the rate of return for this property? So let's dive into the cash flow over the years. Okay, just to have this calculation, and let's look at it from a couple of viewpoints. So in 2014, she put down 20%, about $92,000, right? So for the next couple years, 5, 6 years, she lived in it, so there's no cash flow from the property. We're not going to include any interest costs or cost of ownerships at this point to calculate the internal rate of return. So in 2020, she left, took out equity. She took out $240,000 from this condo to put down on her house. And then over the years, she made money in 2020 because only a portion of 2020 she rented out. She was net positive cash flow. 2021, she made $6,920, almost $7,000 from this rental. Interest rates were still low. And then as interest rates went up, she ended up having negative cash flow years because of rising interest costs. She was on a variable rate mortgage. And 2025, only a portion of it was rented out. The condo sat empty for a couple months because she had to stage it. She had to do some reno, so there was no tenant. So her cash flow for 2025 ends up being negative $12,000. If we take the cash flow numbers, the net cash flow, pay her down payment, and we're not considering anything for the times that she has lived in the condo, including the equity that she took out. Again, that's why it's important to know, because her mortgage balance is larger than her purchase price. And especially after 10 years of owning this property, had she not taken the equity out, her mortgage balance would have been less than $250,000. So we have to for sure factor this in. And then the cash flow over the years, this was her proceeds from after taxes from the sale. This ends up being an internal rate of return of 20%, about 20% per year. And this is an optimistic view because, again, we didn't factor in any costs during the time that she has lived there. There's positives to owning your own property. She gets housing security. She doesn't have to deal with a landlord and a lot of that bullshit. So there's benefits to owning a property. And on top of that, because she lived in it, she paid into the equity, she was able to take out $240,000 for the purchase of a house for where she currently lives. So there are benefits to that. But what happens if we just include the mortgage debt? There's a cost to living, there's a cost to borrowing and living in that place. But let's factor in the interest cost. So once we do that, because she's still paying into a mortgage, we're not factoring in the equity that she's contributing, her internal rate of return ends up to be about 12.4%, because as you can see, it gets lower when we start factoring in these costs. And once we factor in more costs, the property taxes, the condo fees of her being there, her overall return, her internal rate of return ends up being 6.7%. Okay, so substantially lower once we factor in her actual costs of being there. So I like to have several scenarios because we're not including the qualitative benefits of home ownership, of being able to take the next step and using the equity to buy a house to upgrade to a larger home. So in summary, on a cash flow basis, it's about 20%. It paints a very rosy picture, very optimistic because there are no costs included at the time she's living in her condo. And then it ends up being a little bit lower to 12.4% if we include the cost of the mortgage, just mortgage debt during the years that she lived in the home. And then if we were to compare, say, investing in the stock market and looking at all-in costs, it was a 6.71% return. So if you're thinking, was it a good investment? Well, if we compared it to investing in the stock market, the markets return about 10 to 13% in North America. So we can look at it from this point of view. It's hard to quantify the benefits of home ownership and then using that to buy your next property, right? So I would say overall, this is a good return. All things considered, especially what's happening in the condo market in Toronto right now, it's not very good. Had she sold earlier, would she have gotten a higher price? Yes, because right now we're seeing condo prices plummet, but she was really happy with the price that she got and with a less than 30-day closing. That's important too, because the longer closing stretches out, the more she has to pay and the more it's going to lower her overall rate of return because, again, it costs her about $3,000 a month to carry that condo. So overall, I think it was a really good return on her part. She bought this condo 11 years ago, 2014, for a decent price. And from what I've seen with a lot of my clients who own condos that bought after the peak in 2020, 2021 time, they're not doing so well. Their carrying costs are closer to $1,000 a month because they bought higher, interest rates went up. And so with a higher purchase price coupled with higher interest costs, they're probably overall net negative in terms of a return if they were to flip it around now. What impact does this have on her overall financial plan? So if she sold this year. This adds about $500,000 to her retirement. So that's huge. And remember, also going forward from today, she's still net negative cash flow. She was still subsidizing about $600 a month for the year of 2025. So she would still be net negative cash flow this year and into next year because rents are capped and she has to be competitive with the market. And we can see now rents are coming down in Toronto. So the longer she hangs on to the net negative cash flow property, the more erodes her equity and ultimately overall return. So approximately $120,000 of the net proceeds she can take home and she can reinvest that into her RSP. She's going to lower her taxes for this year. And the remaining about $85,000, $90,000, she can pump all of that into her TFSA. That's going to grow tax-free. And when she withdraws from it, it's also tax-free. Remember, this is a goal for everyone. You want to max out your TFSA. And also, she's no longer stressed with the property. There are stresses, responsibility that you take on for being a landlord in general it is harsher in Ontario because the rules are just not very favorable. Overall, this is a positive impact for her future. She got a good return, she got a good price, and now she is more at peace and she feels very relieved, especially with the offer that she got and the overall terms that she got. She gets to close in less than 30 days. And this was something I helped her walk through a few months ago when she was contemplating whether she should sell or hang on to it. She was just on the fence. She wasn't sure, but she was sure as hell sick of carrying this condo because this is after tax money that she has to fork out to carry the cost of owning, renting this condo out. She knew she wasn't going to get like a higher rent for her place. So I helped her walk through her decision making process, made the final call on her own, and it was the right move. So if this is something you need, if you need a second opinion, if you want me to help you run the numbers to see, is this a good time to be selling? What price do I need to get to make sure I get a decent return? This is all part of financial planning, and this is what you get with working with me. And of course, what impact will this have on your retirement, on your future in 10, 20 years down the road? So if this is something that you need, book a call below and let's have a discussion on how it is I can help you with this.